So, 3 reasons to own foreign stocks now. Okay, I use the word now really to just get your attention about international investing. I could have used the word always, but that's a bit boring, Now brings urgency, which I don't like to do because it implies an emergency of some kind, and we certainly don't mean to do that. But I do think investors may be wondering now more than ever, why should I be invested outside the US when the US market is doing so well relative to foreign stocks? Over the last 10 years for US investors, the cumulative return for US markets appears to be as much as 4 times higher. So it's really a reasonable question to ask. So in response, here are 2 reasons for global diversification that I think are true all the time, and a third reason that, while true all the time, may be uniquely true right now. Those 3 reasons are risk management, global opportunities, and something I'm going to call unique diversification, or the currency effect. First, risk management. There are 2 ways to think about this. The first is like catastrophic insurance. You buy insurance for catastrophes like house fires and flood, not because you're expecting an imminent disaster, but just in case that improbable event does happen. What about market or economic catastrophes? In the 1930s, the United Kingdom, Japan, and Germany were 3 biggest stock markets by valuation, only behind the US. The US was less than 40% of the world market at the time. By the end of World War II, the German stock market and virtually all of the Japanese stock market had seen their values go to 0. In the 1960s, the US stock market was the powerhouse, growing to over 70% of world market value. Then in the 1970s and 1980s, the US market lost more than half its relative value to the rest of the world. The Japanese stock market recovered from World War II to represent over 30% of global market value in the late 1980s, only to see that stock market lose 75% of its relative value to the rest of the world by the early 2000s. More recently, the Russian stock market went to 0 when the country invaded Ukraine. One never really knows when what seems like a small regional conflict, say Israel and Iran recently, might trigger something a bit bigger or more consequential, like an economic fire or flood. The point is that stock markets are subject to significant risks. Some are unique to each country. A globally diversified investor is buying a bit of country-specific catastrophe insurance. It may cost a bit in terms of potential return, but it can absolutely pay off should catastrophe strike closer to home. As a point of reference today, the US represents just over 60% of global stock market value, up from about 50% just 7 years ago and closer to 45% in 2010. We have a strong market here to be sure, but having some global insurance is always reasonable in our view. The second reason for global diversification is to take advantage of the global opportunity set. While it may seem like the US will always be the best performing market in the world, some of that belief may be due to a recency bias. The 14 years ending in 2022 saw a 277% cumulative outperformance of the U.S. stock market as calculated by MSCI over stocks in developing foreign countries. That's a stunningly large number. Equally stunning, though, was the 299% cumulative outperformance of foreign stocks over U.S. stocks in the 5.5 years ending in 1989. The point here is not that the U.S. is due for underperformance. There's no compelling evidence that there's a premium for investing in foreign or domestic stocks. The point is that there's an opportunity around the globe, and that diversified investors who have a long time horizon, some patience, they've benefited from global diversification, at times benefited greatly. If you follow our podcasts and blogs at Foster Group, you know that foundational principle number 2 for us is to embrace uncertainty. One thing this means is that we believe forecasts and market predictions are, virtually useless. So what I'm about to say is not a prediction or a forecast, but an observation of why things have been unusually in favor of U.S. investors holding U.S. stocks versus foreign stocks, and why that will likely not always be the case. And it's something we call the currency effect. For the last 10 years, the US dollar has appreciated versus a global basket of major foreign currencies by about 30%, peaking in late 2023. There are a few reasons for this, including our higher interest rate environment, which makes US dollar-denominated treasury debt very attractive. This creates a demand for dollars to buy those treasuries. Also, the U.S. seems to be ahead of the curve in terms of the rest of the world developing and controlling for inflation and continuing to grow our economy post-COVID. This stronger dollar is great if you're traveling overseas, as you have more purchasing power when you convert dollars to euros or pounds or yen, for example. However, the same strengthening dollar has been a net negative for U.S. investors holding foreign securities. As the dollar value rises against the local currency where you may be invested, when you go to sell the security, you get the value of the stock back in local currency. If the local currency is now worth less against the dollar than when you made the purchase, that difference in currency value is made up for or accounted when you convert that local currency back into US dollars. Foster Group Director of Investments Michael Westphal and I talked about exchange rates in the US dollar in a Financial Perspectives episode on July 10th of 2023. Rather than go through all the mechanics of exchange rates, let's just talk about the result. Over the last 10 years, ending February of 2024, the MSCI World ex-USA Stock Market Index had appreciated by 110.59% cumulatively in local currency values. However, for U.S. investors, because of the 30% strengthening of the U.S. dollar in that same time frame, that foreign stock market index return was reduced to 64% when converted back into US dollars. That means US investors received 42% less return than home country investors just due to those currency effects. So where's the opportunity? Well, over long periods, currency fluctuations tend to even out. There's little to no evidence that currency effects should either add or subtract long term for global investors. Do some countries' currencies ultimately devalue and go down and stay down? Yes, they do. But for the larger developed economies, there tend to be fluctuations from year to year, yet over time, things tend to even out due to interest rates and other economic factors. There's no timing guarantee as to if and when this will happen this time, but historically, it does seem very likely. And when the US dollar weakens against foreign currencies, well, that becomes a tailwind for the value of foreign stocks held by US investors. Just to show how unpredictable things like currency and interest rates can be, earlier this year when the Fed was indicating as many as 6 rate cuts in 2024, and Japan was indicating they would move to positive interest rates for the first time in years, some currency hedge funds made enormous bets on the dollar weakening against the yen. Now, just 4 months later, the Fed has adjusted their forecast to 3 cuts or less this year, and the Japanese economy has slowed a bit, causing the dollar to actually strengthen against the yen, making those big short-term currency bets, well, big losers. This weekend, my favorite JZ, that's Jason Zweig of the Wall Street Journal, well, he observed that less than 4 months ago, Wall Street was convinced that the Federal Reserve would cut interest rates a half dozen times in 2024. As recently as last month, he said the Fed itself signaled that it would likely cut rates 3 times this year. This week, however, Fed Chairman Jerome Powell hinted that cutting rates might not be feasible anytime soon, given the robustness of the economy and the stubbornness of inflation. Repeat after me, Jason writes. No one, not even the Fed, can reliably forecast interest rates or the Fed's actions. We would just add forecasting currency effects is equally unreliable. This all reminded me of poker player, psychologist, and author Annie Duke's reminder about accepting uncertainty and unpredictability, especially in the short term. She writes, if we can find ways to become more comfortable with uncertainty, we can see the world more accurately and, we think, be the better for it. Remember, educated optimism is an antidote for anxious uncertainty, and it can be of great help enabling investors to embrace the uncertainty that is with us all the time, including currencies and foreign investment. We hope these presentations contribute to you becoming educated and prepared optimists. If there are topics or questions you'd like us to address, please let us know at our website, www.fostergrp.com, and click on the words Financial Perspectives. And hey, if you're listening to this as a podcast, you can help us spread the message of educated optimism by liking us on your podcast app. As always, thanks for investing some of your time and attention with us today.